I'd like to explain a little bit about warehouse lending. For those who may not be familiar, there's been several high-profile frauds over the last few years that led to these two cases in the Sixth Circuit, one which found for the policyholder and a year later found for the insurance company. We're all familiar now with mortgage-backed securities, and warehouse lending plays a role in the mortgage business. There's a lot of players in the mortgage business. Mortgage loans are actually not usually kept with the bank that sells you your mortgage. They're sold on a secondary market as part of large pools of loans. And there's a good reason for this. The lender who sells you the mortgage often doesn't have enough capital to service and keep the mortgage throughout the life of its term. So it is in need not only of the ability to turn around and sell the mortgage in the secondary market, but also for a revolving line of credit to fund the loan for often a very short period of time, up to 90 days, until it's able to turn around and sell those mortgages on the secondary market. This interim financing is often substantial, offered by warehouse lenders. Tens of millions of dollars of line of credit are often offered. And it's a form of asset-based financing, essentially, which is secured by the original promissory notes that's signed by the mortgagee. A few notes on terminology. The term warehouse really is intended to reflect the short-term nature of the relationship. But as we will see in these cases, even though the individual loan agreements are short-term, the relationship is usually ongoing, and there's a line of credit that's revolving between the mortgage broker and the warehouse lender. A dry funded loan means that the money goes out from the warehouse lender to the bank only after the warehouse lender has received the original documents. A wet warehouse funded loan refers to the fact that the money goes out the door before even the ink is dry. In other words, the original loan documents haven't yet come back to the warehouse lender. As you might imagine, in a circumstance like warehouse lending that are designed to allow mortgages to close quickly, there's a plethora of opportunities for fraud. And what we've seen, for the most part, is mortgage lenders using false or fraudulent documents, forged signatures to obtain the often tens of millions of dollars of line of credit that's ultimately backed by worthless promissory notes.